even the banks were low lying, MTN was moving the market. At a point in time, or even the banks and all the financial institutions that were listed on the market were dropping. Only MTN was the stock that was moving up. We all know, we all have a feel, we've all seen how MTN has been doing in our market. Okay, so MTN is not a stock that is difficult to sell. It is not a stock or a company listed on the market that is difficult to sell. It's easy because we all, one way or the other, have had a feel about how or what MTN does in our homes everywhere. Okay, so the current price of MTN, 6 cities 42 pesos. Our fair estimate after we did our calculation, the fair price stands at 6 cities 95 pesos and is the number one most valuable stock on the Ghana Stock Exchange. Total return plus the dividends puts it at 15.4%. Total return plus dividend puts it at 15.4%. Now, we would go into what MTN Ghana is and how it makes its money. So, when you are doing your analysis, you need to make your investors understand what the business is, the business that you are presenting. Okay, so MTN listed on the Ghana Stock Exchange is the country's largest telecom and digital services company. It has 5 income streams. Data is now the engine. So from the analysis, we found out that data, Q1 service revenue, data, internet is the biggest and fastest growing source. That is 59% of the entire revenue for MTN. So anytime you are doing your video call, you are watching your videos on YouTube, on TikTok, and so on. This is what is driving the revenue for MTN. Okay. Then number 2, we have the mobile money. Momo payments and transfers is now separate. It's now a separate company from MTN. All right. It's called the Mobile Money Fintech Limited. Mobile Money Fintech Limited. Voice phone calls is shrinking now. It's now on a downward trend. And this is mainly because people are moving to internet calling. People are moving to internet calling. Now, digital, streaming, gaming, content, it's small, but doubling every year. Okay, it's doubling every year. So this is what constitutes how MTN Ghana makes its money. Okay, so data is 59%, mobile money 24%, voice is 13%, digital 2%, and others 2%. So you need to show the structure of the business that you are analyzing. Okay, the first page talks about is the thesis, talks about your background. Okay, investment thesis. You can make mention of it that way. To make everybody understand, we put the bottom line. Okay, so the bottom line is that you should buy, and these are the bases that you should buy, and these are the how MTN Ghana makes its money. What is MTN? What it does? What it does. So now we will look at the financial trend, the financial statement analysis. It's proper. All right. So it's a powerful 5-year. There's a powerful 5-year track record of MTN. We did the analysis from full year 2021 to 2025. Now, as part of this, I have record of Q1 2026, because at the time of putting this data together, these were the data that was available. Q1 2026. Okay, so between 2021, 2022, 2023, as you can see the trend, there has been an upward trajectory in terms of performance. So revenue has grown from 7.7 billion to 24.4 billion. It has grown 3.2 times since between 2021 and 2025. This is full year. 3.2 times. 3.2 times 7, from 7 to 24. 7 to 24, 3.2 times. Okay, looking at profits. Profits too has grown from 2 billion in 2021 to 7.8 billion in 2025. This also has grown 3.9 times. Now, EBITDA, this I'm going to break it down for you. All the things. Earnings before interest, taxes, depreciation, and amortization. So, EBITDA margin, we'll go through that, the formulas for all those things. I don't want to use this session to be showing all the calculation. This is just to open you up to what the presentations have to look like. So EBITDA margin in Q1 2026, okay, came up to 61.2%, and this is very positive. Above all, the market has responded to this positive trend with a share price appreciation of 53% from beginning of 2026 till now. Okay, so this is just a snapshot of the financial performance since 2021. This is a snapshot of the financial performance since 2021. Good. Now we want to look at the transition into fintech. So all these things are giving the background of how the company has transitioned, or what the company is. Okay, so MTN is no longer just a phone company. It's becoming a financial platform. This is the single most important shift in its story. Okay, so let's look at how the trend has been. Momo revenue since 2021. 2021 revenue was 1.7 billion. In terms of mobile money revenue has grown 3.5 times in 4 years, from 1.7 billion to 6 billion Ghana cedis. And this is very positive. So that is why we always push for people to buy stocks in MTN. We always push for people to buy stocks in MTN. When you buy stocks in MTN, you are a shareholder of the fintech, mobile money fintech, as well as the phone company. Okay, so the Momo engine, mobile money, lets people send, receive, save. We all know how Momo works. And the separation, that's a big chance. On 31st March 2026, the Momo business was split into a new company, Mobile Money Fintech Limited. To meet Ghana's fintech ownership rules, shareholders still own it fully through a stapled share. Okay, and this is why it matters to investors. Fintech carries higher growth and margins than voice. Digital revenue alone doubled 107% in Q1 2026. Digital revenue alone doubled 107% in Q1. The separation also means Momo now pays its own dividend, extra cash to shareholders. This basically is the reason why we encourage investors to buy stocks in MTN, because it is a whole hub, is a whole engine for growth for investors. Now we will look at the valuation. If you pay attention, we looked at what the company is, how it earns its money. We looked at the financial trend, the strength of the company through its past records. Now we're going to look at the valuation. In this document, we looked at four valuation methods. However, we based our buy recommendation without one. That is the residual income. So these are the methods that we use. We're going to teach you how to use or how to calculate all these methods. I'm going to show you how to use all these methods. So for the DCF value, the DCF discounted cash flow method, it values all the future cash the business will generate discounted to today. This method is what a lot of people use, and it's termed as the most appropriate. However, this DCF approach is not appropriate for financial institutions. When you are valuing banks, it is not appropriate to use a DCF method. Commercial banks, the way the structure is, if you do not use it very intelligently, you may record a lot of negative free cash flows, which will affect your value. So DCF valuation, you can use it for manufacturing, you can use it for telecommunication, others, but not with commercial banks. So DCF values all the future cash the business will generate discounted to today. All right. And we have the dividend discount model. This model is appropriate for companies that pay regular dividends. That pay regular dividends. That pays regular dividends. Okay, so it values all future dividends discounted to today. Again, we'll go through this valuation model step by step. We'll make sure you understand. Okay, that's why I encourage you to tell your friends that they should all join this program. It is very important. It's not just for employment purposes. You these days, a lot of youth want to go into their own businesses, and it's important that you understand these things. It's important that you understand these things so that you can value your own business. Value your own business, then you can sell them off. If that is what you do, you want to start a business, you can start, value it is valuable, you can sell it off. All right, start another business, you can sell it off. I mean, all these things are ways that we can use to make a lot of money. Okay, so dividend discount model is another one. And we have residual income. It tests whether the company earns more than shareholders require on their capital. Okay, then we have the market multiples, which compares MTN's price to earnings against peers and justify it for fair multiple. Okay, now the numbers behind the evaluation. Every input either market observed or calculated from the financial statement. We don't want you to make guesses. No guesses. Don't make any guesses. So all the factors, every input has to be backed by data. So as you can see, we are seeing that risk-free rate here is 11%. There's a beta here. Beta, there's a way to calculate beta. I will take you through the full process of calculating beta. It is not difficult. The stats people, they want to make the thing very scary. It is not difficult. We'll take you through the simple approach to calculate beta. I'm going to take you through how to get the equity market premium as well. We have what we call the cost of equity. The cost of equity will take you through the process as well. Then the GDP, the growth rate, long run growth rate, when to apply all these factors. Okay, so these are the inputs or the factors that you need to do your valuation. It's not exhaustive. There are others that we can use. Okay, we'll take you through why you should pick the data and when and how to calculate them. All of them, you know how to do them. Now, method one, discounted cash flow. So we project cash flow to equity for 5 years. Then a terminal value and discount everything at 16.8. 16.8 is the cost of equity. Don't be afraid. We're going to go through how to get to the cost of equity. Then again, let me remind everybody here that we're going to go through this session again this evening between 8 to 9. So make sure that you join. If you join this session late, don't worry, we'll have it again between 8 to 9 p.m. Make sure you join. All right, so we have the FCFE growth rate and the FCFE, free cash flow to equity. FCFE is free cash flow to equity. We have the free cash flow to firm. We have free cash flow to equity. we will know after the whole session, we'll know when to use what. We have the cost of equity, we have the WACC. When do you use WACC? When do you use the cost of equity? There's cost of debt, cost of equity, there's WACC. All right. So all these things are jargons that we use when we are doing our valuations. But I'm going to take you through them. I'm sure on Monday we'll start opening up on the valuation terms on how to get all these things. So year one, we will calculate the present value at the cost of equity of 16.8. After year five, you put the sum of the 5-year discounted FCFA, and you find the present value of the terminal value. It's becoming a bit complex from here, I know. Now you just follow. We'll take you through everything. This is just to open up on what to expect and how technical you'll be going forward. You won't be very simple. You start speaking in finance terms. So starting FCFE, the formula, the approach is stated down the table. So equity value 112 billion divided by the issued shares. You come up with the DCF value of 8.45. Now, the dividend discount model also follows the similar approach of the DCF explained earlier. So dividend growth listed from year one to year five. Dividend amounts are listed there. Discount factor, the same as the cost of equity. The sum of the 5-year discounted dividends, present value using the growth of 6%, comes, then you can calculate to get your 6.2%, that is DDM fair value. Okay, so this is the dividend discount model. And we have the residual income. Residual income, that's the method 3. Return on equity for each year. It has, the return on equity, and you have the forecasted return on equity. So this is also the approach for the residual income model. We're going to break this one two down. Okay, so the RIM or residual income brings the price to 3.8. So as you can see, all the models for every financial analyst, for any person that wants to value a business, you need to know various methods of valuation. So we have the DCF, which brings the price. If you want to just rely on the DCF, then you can see that MTN, the current price, is too low. So 8.45 is the fair price. If you want to rely on the DDM, you can say 6.24 is the fair price. And the RIM would say no, MTN is overvalued. Then the market multiples will come to 5.59 and the stock is overvalued. It's because we, as financial analysts, we don't rely on one valuation model. We need to apply at most 3 when you're doing valuation, at most 3. So with me, wanted to be, I won't say biased, but I wanted to be forward looking for MTN, having the experience in the market, I decided to rely on the DCF, the DDM, and the market multiples. Okay, all right, because the RIM brings the price to this level, I think that it is not a true reflection of what MTN, how to perform in the market. It is not just the figures. You have to also understand the dynamics of the market to be able to make your judgment. So based on the dynamics of the market, I don't think that MTN is a 3.83. I think that is worth more than this. Okay. Which method says. Now, the residual income, as mentioned earlier, it's saying that the price is high. DDM also put the price very high there. I didn't put I'll rearrange the figures well. Okay, so after that, you find the weight. So as we said, the DCF is a gold method, is a gold standard method. So that comes with the higher weight. So the price that you get, you multiply it by the weight. We'll go through all those methods. We'll go through all those calculations. All the prices the values that you get, you multiply it by the weight and you add them. So the blended target is 6.95, which puts it as also a very strong position that you should buy. So each bar in one method's answer. So the gray hatched bar, as you can see, is shown for completeness of the methods. The red dashed line is today's price. As you can see, the green is a blended target price. So I'll rearrange the figures there so that we can fully understand this better. Now, for every analysis, you need to do what we call scenario test and sensitivity analysis. Sensitivity analysis. So assuming the price we wanted to include the residual income, what would have been the price? So in adding or including residual income, the price would be 6.42. 6.42. Okay. So with residual income, sorry, the price would be 6.17. Sorry, 6.17, as you can see on the left bar, the gold bar, 6.17. And this one, it comes with the recommendation of a hold. Without the residual income, the price falls at 6.95. So we lean to 6.95 without residual figure because MTN's book value this quarter was cut by 1.9 billion. So every decision that you make, you have to back it with some figures. And it is important that you take your time to pick the figures. Take your time to pick the figures to understand. Okay, so both numbers are showed in this valuation. We don't want to hide anything. It is important that you open up every information to investors for them to decide. I hope it's clear. So sensitivity analysis also goes with the price. All right, sensitivity analysis. So this is a table that shows the cost of equity and the growth rate. So the long run growth is what you can see down the screen, and the cost of equity is what you can see on the left. Okay, so with the current scenario, which we use the cost of equity of 16.8% and a growth rate of 6%, the price is 6.95. That's what we've fallen on. However, when the cost of equity goes to 6, when the cost of equity is at 16.8, all right, and the growth rate is 5%, the price will be 6.62. All right, you look at it where the graph joins. So 6.62. If you don't understand, you can ask questions later. All right, when is cost of equity 16.8 and the growth rate is 4%, the price will be 6.34. But looking at the top right corner of the screen, when the cost of equity is 14.8 and the growth rate is 8%, the price will be 9.74. That scenario is most unlikely. So what this tells us is that when the cost of equity is high, the price is low, even at a high growth rate. When the cost of equity is high, even with a high growth rate, the price or the fair price is low. So the most perfect scenario would be that growth rates will be good and the cost of equity will be low. Oh, yeah. So I think we can continue. Now, this is the final slide here. I mentioned I explained the buy position, I explained the hold position. Target price 6.95 versus current market price of 6.42, right? And there's a price upside of 8.2%, dividend yield of 7.2%, total return going forward 15.4%. In advising investors, you don't just rely on this. You look at the comparing investment opportunities within the industry. So what can you compare MTN with? The next item of comparison would be treasury bill. What is the current treasury bill rate? So in case investors or an investor wants to buy treasury bill, the rate is around, let's say, 11%. Is it worth it to hold MTN rather than buying treasury bill? Treasury bill is 11%. MTN, when you hold it for the next 12 months, you're getting 15.4% return. Is it worth it? I would say yes, it will be worth it. Okay, because of the risk premium. So the premium is the difference between what you are getting from investing in the stock and what you are getting from the risk-free investment. So 11 minus the 15.4 is the premium that you hold on to. So hold and collect the growing 7% now, paid quarterly, 7% dividend. Buy for income and long-term growth. Add on any dip. Okay, if the price goes to 5.6, perfect timing, you have to buy more. And it's a quality core holding for any Ghana equity or pension portfolio. This is the pitch document. It explains everything that an investor needs to know. And for you guys, we have diverse backgrounds. Some are reading finance, some are reading accounting, some are reading social sciences, all the various courses. This is expected to explain the processes that you go through in analyzing an investment. And these steps are the same steps that you use to analyze a lot of the investment assets. Okay, so this is the end of the presentation today. We'll go over this again this evening at 8 p.m. Make sure you're available to join. Okay, so Kelly, Emmanuel, I think this is the end of the presentation. If there are any questions, you can ask. If there are no questions too, we can hold on so that we can answer them this evening. All right, thank you very much. All right, I can see some hands up. We have up to 8:30 to finish everything. Okay. All right, let me ask, okay, Wasila. Wasila, you can ask your question.
Okay, good morning and thank you. Please, my network wasn't stable, so at a point in time it was just breaking. But then when I joined, I heard something like you should subscribe to the channel. So I want to know the name. Is it Young Investors Analyst Programme on YouTube or it's a different name?
So this is the Young Investors Analyst Program.
Yeah.
Young Investors Analyst Program, and it's a preparation towards understanding what or how to do a pitch document, an investment recommendation. So that is the Young Investors Analyst Program.
So my question is, I mean, with the YouTube, we subscribing on YouTube to get a video to watch. Is it the same name?
I think I went up briefly. So what Wasila Zakari Mustafa. All right. So if Wasila is not available, Isaac Campofo, you can ask a question.
Sorry, my network was like it's breaking. I think you've answered my question
Okay.
already.
All right. All right. Sure. Sure. Eric Awuku, please ask your question. Eric Awuku, please ask your question.
Wait, but yes, please. And there's another one too. Yes, please ask my question.
We can hear you. Can you speak?
Yeah, I said, what did you use the treasury bill rate? Like you said, the industry, you compare the MTN with the industry. So, like, what did you use them? I was thinking probably you use like a company within the telecommunications firm instead of using the treasury bill. Then my second question is, one time I watched one of the videos, and then they said that when you're using the figure, since stock investment is a long-term investment, you have to use like a span of let's say 10 years. But I noticed that in one of, I think, the interest-free rate was just for 1 year. So my question is why?
Investment decision is on what so for the comparatives, which company we compare with. We, I want to ask you, which company on the market do you think we can compare MTN with?
Apparently, to the best of my knowledge, there is MTN is the only telecommunications uh, company on the market.
Is the come again?
It's the only telecommunications company on the market.
Okay, so that's why we use the treasury bill to do it.
Okay, so if I understand, if there is the firm is the only like firm as in that particular industry that is on the market, you use treasury bill.
Yes, yes. I mean, you can use other investments. You can select any of the banks, but because this investment is focused on 12 months, we the idea behind it is not good to go beyond 12 months. So, which other option is available in the next 12 months? And that is treasury bill.
Okay, okay, thank you. And please, my second question with regards to the interest-free rate, I noticed it was for 1 year, but then I watched previous uh, stock pitch competition videos, and then the judges were like the people should the competitors should have used 10 years since we do stock investments for a long period.
Yes, yes, yes. So it comes with to the same response. The objective of this one, we want to get people to enter the stock, not to go for 10 years. All right. It depends on the perspective of the person doing the analysis or the investor. So the assumption is that my investor wants to do the next 12 months. All right. So the next 12 months, which other investment is available? And that's why we didn't use the 10-year bond. That's why we didn't use yeah, 10-year rate. We decided to use 91 3 bill. That I think that's required. But in case you want to do your investment for the next 10 years, for the next 5 years, you compare with like factors. Okay, like indicators. So in the next 5 years, you use 5-year risk-free rate. You want to use 10 years, 10-year risk-free rate. You want to do 12 months, the same scenario. So that is the reason why we chose this approach. Is it clear? Eric. All right, Isaac Ampofu, please ask your question.
Okay, thank you for the great presentation. But unfortunately, my network wasn't that stable. It was on and off. So even though a lot was said, sometimes by the time I come on board, the explanation will be in the middle somewhere. So this morning, I didn't really get the explanations to the presentations. So I was asking, is there a recorded version of this morning's session? And then if possible to a copy of the slide. I tried taking some screenshots, but because the network wasn't stable, I got some, I didn't get some.
Okay, thank you, Isaac. I made
Okay.
mention that the slides will not be made available to you. What will be made available will be a video on our social media handles, that are Young Investors social media handles. So you have to subscribe to the channels and pick copies from there.
Oh, okay. Okay.
And we're going to have this session again this evening from
Yes, yes.
8 to 9 p.m. So you can join again so that you can be able to have an understanding of the full session again.
All right.
So in understanding these things, you have to consume it a number of times. You have to consume it a number of times. Okay. All right.
Thank
Thank
you
you.
very much.
You're welcome. Andrew,
Thank you
Johannes.
very much. Please, I'm not audible. Hello.
Andrew, your network is quite bad.
Hello, sir.
Yes, Andrew, I can hear you.
Yes. So, sir, my question has to do with valuation methods. Some analysts prefer to use the financial ratios. So, how effective is using only the financial ratios to make your analysis?
Okay, so the financial ratios are equally very effective. They show the true picture of the performance of the company. But as I mentioned earlier, for every person that is a professional valuer or an analyst or a corporate advisory person, we don't rely on one approach. We use various approaches. That is why we want to train you in different valuation methods so that you can have the blended approach or the blended recommendation for your investors. So you open it up like the way I opened this one up. You show the DCF, you show the DDM, residual income, the multiples. You show all of them. Then you can make your recommendation by applying the weights on them. So it's equally very effective. I could have ended with the DCF. DCF. It would have there would be nothing wrong with it. However, I decided to use other models so that my investors will understand every angle that I'm coming from. It is important that for every analyst, you apply the various approaches that will show your professionalism and your expertise in the field that you are in the field that you are operating. All right. So success. Your hand is up.
Hello, how are you?
Hi, success.
Thank you for the presentation. For my questions, more on the admin part of it. Is this the first session of the analyst program, or because I think I applied last week and then I got the email to start attending today. I'm on the first session, or
Yeah, this is the first session. This is the first.
this is the first session.
The next session will be this evening between 8 to 9 p.m. and then we'll have another session tomorrow. So it's minimum 3 times in a week. Monday, Tuesday, Wednesday, Fridays. But on a daily, we're going to have morning and evening
Oh, okay.
sessions. Is that
Because I'm currently based in South Africa, so I see like this is more on the Ghana. So is this like is same calculation throughout? So that's mean I can also apply it in South African market.
can you see that again?
I'm saying like this is based mostly on Ghana and
Yeah,
I'm from South
yeah,
Africa.
yeah, yeah.
I'm saying the calculations that are being used here can be applied on South African
Yeah,
market.
it's global. It's global.
Oh, okay.
It's global.
Thank
Even
thank you so
when you
much.
go to the New York Stock Exchange, it can be applied there. So that's why we're encouraging everybody to pay attention because it's not just a local thing. It's not just an African thing. It's a global thing. Okay.
Okay. Thank you.
You're welcome. Success. Al Hassan, your hand is up. Al Hassan.
Um, Malasan Eweko, joining from Nigeria, Lagos.
All right, welcome.
Hello.
Yes, we can hear you. Please go ahead.
Oh, I don't know if my audio is clear.
Yeah, we can hear you. Go ahead, please.
Yeah, this is Malasan Eweko, calling from Lagos. I just want to have a clarification as regards the timing, because the Nigerian difference is I think there is actually a 1 hour ahead of Ghana. So I just want to be sure, is the morning section also the same with the evening session? And is there a way we can actually have a structure about how the training will be going? Thank you.
Can you come again with the question? I think the last part I lost you a bit. If you can come again, please.
Okay, what I was trying to say is, there is actually a time difference between Ghana and Nigeria.
Okay.
So, and I wasn't too sure because I saw 8 o'clock, 7 o'clock. I was unable to join at that time, so I thought I've lost. So I just let them just join now, and I saw like a lot has been going. So, and I saw there's a morning and evening session, so it wasn't really clear to me. So I just don't know if they can actually um try to be clear on that aspect. Like, is it those who join in the morning, can they skip the evening, or you have to join both the morning and evening?
Okay, I get you now. So, like I've had the session this morning, there's going to be a repeat this evening. There's going to be a repeat this evening. All right, the same content that I've taken you through this morning, I'm going to have it again this evening. And I'm going to open it up a bit tomorrow morning. Okay, so I think that I'll get in touch with the administrators with the time. Maybe they'll make mention of it has to be a GMT so that we can all be able to adjust. So I can see that if it's now that it's 8:28, it's 9:28 in Nigeria, in Abuja, that is Abuja time. So maybe the administrators will pick this up and try to let you know so that you don't miss any of them. But as I mentioned, it's going to have it minimum 3 times a week. It could go up to 5 times in a week, but it's going to be a morning and evening session. Alasan, I hope you're okay. All right. So Prince Afari,
Good morning,
good
and
morning.
thank you for this nice presentation. So, when you started, I heard you mention you were going to go through the buy and hold, but from what I saw, it seems you only went through the buy and not the hold. Or I'm mistaken.
Okay. No, you're not mistaken. We'll go through that in detail. This is not we will be open. I don't want to confuse anybody here. All right. So I'll open up every bit in subsequent presentations, but we're going to have a repeat of this evening so that if you don't understand anything or how it flows, you can still follow and ask further questions. So we're going to open it up in subsequent sessions. Okay, how we fell on the hold. So the reason is because of the residual income that we added to the valuation methodologies. The valuation methodologies, the residual income brought the value to a lower version, which affected the whole blend approach. So we're going to go into all those valuation methods so that we all understand. Prince Afari,
Okay,
is
thank
that
you very
okay?
much. Yes.
You're welcome. Stephen O2. Stephen. Okay, so thank you all very much. If Stephen is not, let's meet. Okay, let's all meet this and go over this again for everybody to understand. Thanks a lot, and have a very good day. Thank you all very much.